I'm looking at your notes, Kenneth, and you're saying look for these idiosyncratically driven trades that aren't very much correlated with global risk. So, given that we are looking at earnings season coming up, is it time, is the market ready to look back at fundamentals now?
Yes, I mean, this was really a story for the end of last year. Going into the end of last year, we saw that investors were getting a little bit too bullish with respect to the risk they were taking. There wasn't sufficient differentiation of risk within emerging markets. You were seeing increasing amounts of flow into, the highest volatility parts of the local currency emerging markets. And, for us, that was the opportunity to sort of start de-risking our portfolios, come out of some of the more sensitive markets and look for trades like indeed Chinese bonds, which is a market that we've been investing in for actually a very long time, several years. It's now becoming obviously a trade that's more in focus given the opening up of the markets and the potential inclusion of China in the Bloomberg Barclays Global Aggregate Index. But if you had allocated to that trade, then it's more when you look at the relative performance of China versus, say, the rest of the emerging market bond markets. It's obviously very clear that that would have given you some degree of resilience within your allocations, and you would now be able to look to maybe reposition some of that risk at this stage, with the proviso that the currency was actually, from our perspective, looking a little bit expensive, and so we did have some hedges on the Chinese yuan. So a lot of the discussions now amongst the team are when and how to start unwinding some of those hedges.
By and large, if you look across the region, are you looking more favourably upon corporate rather than sovereign?
It's a real mix. On the corporate side, you take it on a company-by-company basis, but there are opportunities within the credit markets. I think the correction in credit valuations and spreads has come a little bit later than what we saw in the local currency markets, but that has certainly happened, and we certainly are looking at some opportunities within the credit space. But similarly, on the local currency side, there are a number of markets that have seen some significant corrections, like, for example, Indonesian bonds, where, to be honest, the fundamental story has not really changed. So it's just getting caught up in this very negative global sentiment, and that is exactly the kind of environment that we are able to go and find, attractive valuations in markets.
And as far as Indonesia is concerned, do you think the timing is right to start looking there? In other words, is Bank Indonesia done hiking rates, in your view?
So the real question comes down to a risk budgeting exercise. We have to be aware that these trade negotiations and trade wars and headline news, very negative sentiment around these things is not likely to necessarily disappear. I know the market is, calmer today and the risk is rallying, but these discussions and tit-for-tat policies is likely to persist for quite a while. From Donald Trump's perspective, he doesn't really have an incentive to back down on it. It seems to be hitting the right notes with his voter base. It's asymmetric geopolitical risk. From China's perspective, obviously, they don't work on 4-year political cycles. So, you could argue that near term there's a limit to how negatively they have to respond, because they can wait and see, how the U.S. midterm elections go, how national elections in a couple of years go, and whether President Trump is really still going to be in power at that stage. But nevertheless, we are going to have this very negative headline news persisting for a while. Volatility will stay high, and you have to make sure that you can sort of ride that out. So yes, you should be looking for periods of weakness to add risk, but you also have to make sure that you can do that over a sustained period of time.
Right. Kenneth, can I ask you about a more domestic story? Because you alluded to Indonesia as perhaps a function of what's happening outside. I want to ask you about the Philippines, because you have inflation on the way up there in the country. The past several weeks has seen the finance ministry come out and essentially cancel several bond auctions, and which I would imagine would be down to them to higher rates being asked in the market. Is that a group of securities? Would you be touching Philippine debt at this point in time?
I have to be honest, this has been one of our structural underweights for quite a while, and it's not just because of necessarily the fundamentals, though the fundamentals haven't really been conducive. You've had the country shifting back to a current account deficit position, not necessarily for bad reasons. You have seen improvements in investment growth, and that has obviously resulted in higher capital imports. So there will be a growth dividend, down the line. But this is not the kind of environment that is conducive to running current account deficits. You have obviously had a robust growth environment and inflation picking up, and the central bank having to hike. Beyond all that, that, however, you have a market where, to be honest, bond market liquidity is one of the worst in the region. Even if you get through that, you're dealing in an environment where the taxes are quite high. And so the hurdle rate for being able to justify trades in this market is quite high. I would say it has underperformed for a sustainable period of time. So we're maybe getting close to a point in time where you could start to think about maybe reducing your underweight. But we certainly wouldn't be anywhere close to a period of time where we'd be advocating going overweight.